Imagine you're a manufacturer watching a relationship with a single customer grow so fast it starts to reshape your entire building. Now imagine the money for that reshaping shows up in chunks, gets spent on expansion, and then years later the IRS shows up and says, that wasn't a gift to your capital structure, that was income. Here's the escalation the court had in front of it. First, the company received roughly $4,085,000 for the expansion in 2017. Then the total funding grew to around $4,300,000 once an additional payment arrived in 2018. That's a 1-year jump, and an increase was in the order of $205,000. And then the dust settled. The final allowed amount to keep out of income was zero, meaning essentially about $4,300,000 ended up treated as taxable income instead of an excluded capital contribution. That's not a free expansion story, that's an income story with a very expensive moral. I'm Alex Dvorkin, I'm a certified public accountant in the state of California, and if you like these deep dives, please like this video and subscribe to this channel, because this channel reviews and analyzes US tax court cases to understand how US tax law works. In this video, we cover the tax court decision in the case of Thermal Circuits versus Commissioner of Internal Revenue, decided on March 30th, 2026. The story starts with what this petitioner actually does. The company designs, engineers, and manufactures foil heating components, and it had been making this kind of products for decades. The manufacturing happened in Salem, Massachusetts, inside a facility the company leased. Then in 2013, a huge new customer entered the picture through a subsidiary called Nico Ventures Trading Limited, what the opinion calls NVT. NVT was working on a heat not burn tobacco product called GLO, and the heating element was the key part of that device. NVT engaged the petitioner to design and produce that heating element, and production began in 2016. At first, the output looked manageable, approximately 10,000 units of foil heated per week, and NVT paid approximately $10 per unit. But the NVT, that was nowhere near enough. They needed more. The opinion frames NVT as trying to break into massive market, a $5 billion industry, and it wanted nearly 20 times the weekly heater output, while still paying the same per unit price. The manufacturer tried the most obvious, lever first, run the lines longer. But overtime did what overtime does. The court notes that labor overtime cost raised the price per unit by $1.81. And that number matters because it becomes part of the whole economic logic behind what happened next. The customer wasn't just buying a product. It was trying to buy a price and volume outcome. So the company faced a classic business cliff. Stay the same size and disappoint the customer, or expand the facility and bet heavily on the customer's appetite. And the opinion is very candid about the fear on the manufacturer's side. As a relatively small manufacturer, it was wary of putting all eggs in the NVT basket. The worry was simple. If the customer's demand disappeared, the manufacturer would be saddled with more manufacturing space and machinery that it could effectively put to use and afford. The company initially pushed for a safety net, a minimum production floor where the customer would guarantee buying some quantity. The customer refused to that agreement. But the negotiations didn't die, they shifted. Eventually NVT agreed to fund the expansion to accommodate the capacity increase. And then, almost like the customer wanted a seatbelt too, it proposed a damages clause. The court describes it as a clause that would require the manufacturer to pay the customer if after the customer funded the expansion, the manufacturer did not produce a sufficient number of foil heaters. But the manufacturer held its ground and no damage clause was agreed to. By January 2017, the company had plans for a major expansion. The additions involved with different square foot options and different production capacities until NVT agreed in June 2017 to a larger option. That agreement came with a detail the court would later treat like a flare gun. NVT issued a purchase order captioned Prepayment for Heater Capacity 2018. Construction began in July 2017. The opinion walks through the reality that the money flowed through a related entity, but the parties agreed and implicitly conceded that the manufacturer was more properly treated as a recipient, with the other entity acting only as conduit to pay the builder. As the space was built, the company and NVT also tried to paper the relationship. There was a draft framework agreement, and it included a section titled Capital Investment. It talked about NVT funding additional machinery, equipment, or facilities, and it tried to lock down a concept: ownership of and title to that property shall remain vested in NVT. But here's the first major plot twist. The draft agreement was never fully executed. Meanwhile, the physical world kept moving. By late 2017, much of the expanded facility was complete, and the company got a certificate of occupancy from City of Salem in November 2017. The facility ended up with additional 20,000 square feet of manufacturing space and an additional 10,000 square feet of office space. Production lines were installed one by one, and output increased while construction was still ongoing. In May 2018, the parties signed a different document, the Supply Heads of Term Agreement, described as the only contract ratified by both parties. This one focused heavily on equipment. It created the concept of dedicated equipment funded by NVT, restricted how it could be used, and repeated the ownership theme. Title: the ownership shall remain vested in NVT. And then in 2021, the relationship ended. NVT terminated it and instructed the company to destroy the dedicated equipment. The manufacturer tried to persuade NVT to sell it at a discount or donate it, but NVT was insistent, and the manufacturer ultimately agreed to it. The company even sought written permission to use the expanded space afterwards, got no response, and left the addition unused. Now comes the tax heart of the story, the money. NVT provided about $4,085,000 in 2017 and roughly $205,000 in 2018, bringing the total to about $4,300,000 for the expansion. The company did not report any of it as income on its corporate returns. Instead, it attached a disclosure form describing the receipts as non-shareholder contribution to its capital, and it said it relied on the Supreme Court's 5-part test from Chicago, Burlington, and Quincy Railroad, and on Section 118A. It also did something that in context reads like it was trying to be consistent with the story. It did not deduct any depreciation for the portion funded by NVT. The IRS didn't buy it. A notice of deficiency arrived in July 2021. The tax court frames the central fight very plainly. The parties disagree on who owns the resultant leasehold addition. The company argued essentially that the customer owned it, at least in equitable sense, even if legal title sat with the company. But the court says this crucial part was never specifically memorialized, and there was no other concrete evidence proving the customer owned the addition. Then the court lines up the facts that made the ownership argument collapse. There was direct evidence showing the manufacturer's ownership. It paid the insurance and taxes. It bore the risk, and certificate of occupancy is in the manufacturer's name. The court concludes the company has not carried its burden to prove the customer owned the addition. Once that domino falls, the next one is gross income. The court reminds us gross income is all income from whatever source derived, and it includes cessions to wealth, over which the taxpayer has complete dominion. And the court's telling the company ended up in possession of leasehold addition worth $4,300,000, and that's a cession to wealth. So the company tried its main shield, Section 118A, the rule that says a corporation can exclude a contribution to capital of the corporation. The court explains the analysis focuses on the transfer's intent, and where intent isn't explicit, courts look to the 5-factor distilled in CB&Q case. Here's where the narrative becomes almost painfully human. The court basically says, even if the money built something permanent, the customer wasn't doing this out of corporate kindness. On the permanent working capital factor, the court actually agrees the money became part of the company's working capital structure because it was provided for the sole purpose of building the addition used in manufacturing operation. But the compensation factor is where the case turns. The court explains the choice NVT faced: pay higher per unit cost due to overtime, or fund a major expansion to the manufacturer that could produce more units at the same per unit cost. The court notes NVT ran the numbers and believed it would recoup a cash outlay after purchasing about 2.5 million heaters. That's not a vibe of capital contribution, that's the vibe of the customer doing return on investment math. And that purchase order caption, prepayment for heater capacity 2018, gets treated as revealing the true character of the transfer. The court says that caption shows NVT linked its investment to an advanced payment on future foil heaters. The court's conclusion lands hard. The funds were clearly to be compensation for a service, future production volume at higher output and lower per unit cost. So, on intent alone, Section 118A exclusion fails. But the court doesn't stop there. It adds an alternative lock on the same door. Section 118B. It explains that Section 118BA excludes from contribution to capital anything that's in aid of construction or made by customer or potential customer. And here the parties don't even dispute the key triggers. The funds were used to construct an addition, and NVT was buying heaters in significant quantities and intended to continue. That means the statute itself forces inclusion in income. Then comes the timing question. Which years does the income hit? The company used the accrual method, and the court applies the all events rule. Income is includable when the right is fixed and determinable with reasonable accuracy. NVT paid about $4,085,000 in 2017 and about $205,000 in 2018. Even though construction finished in late 2018, production capacity was coming online during 2017 as lines were installed one by one, with production increasing incrementally. So the court requires the 2017 payment to be included in 2017 income and 2018 payment to be included in 2018 income. Now, just when you think this ends, and then the IRS also stacked on penalties. The court gives the company partial win. The IRS asserted inaccuracy-related penalty for 2017, but the court ultimately finds reasonable cause and good faith. This is subtle, and it's one of the more interesting human parts of the opinion. The court says the company's position depended on a mistaken factual belief about ownership, but the mistake does not prove fatal to reasonable cause. Why? Because the documentary and behavioral pattern made the belief understandable. The court points out the drafts and the signed agreements repeatedly emphasize NVT's ownership of dedicated equipment, and the draft included facilities and the property NVT claimed ownership over. The signed agreement also used language asserting ownership over dedicated equipment, including premises. Then the court looks at what the parties actually did. The company used the equipment and the addition only for NVT's heaters, destroyed equipment when instructed, sought permission to use the space after termination, and even skipped depreciation. The court calls it an honest, though mistaken belief, and that's enough to wipe out the penalty. So the ending is a split screen finale. On one side, the company must include essentially the entire $4.3 million in income across 2017 and 2018. On the other side, no accuracy-related penalty survives. And if you want the key takeaway, it's this. If a customer calls something prepayment and the business relationship looks like a cost-benefit plan to buy cheaper units through your expanded walls, you may not want to label that money as a warm, fuzzy contribution to capital and hope the tax court finds it adorable. My name is Alex Dvorkin. I'm a certified public accountant in the state of California, and if you like this video and found this information useful, please give us thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.